I am a futures and options broker. I'm a broker. We run a little boutique brokerage in Las Vegas. We only deal in futures and options on futures, which means we're quite a bit different than the big houses. One, we answer our phones, we answer our emails, and when we do answer, believe it or not, we can actually answer any question you probably have about trading futures and options because this is what we do. We're not clerks. We're in the trenches. If you have any interest in this sort of thing, this is my contact information. You can find me on social media. Our website is decarlytrading.com. I think last I checked, there was like 43, 44 videos. They're all free to access. So if you're interested in learning, check those out. And if you're on social media, we're on Facebook, Twitter, Instagram, YouTube. If you just type in either DeCarly Trading or Carly Garner, they'll come up. If you are not an animal lover, you might want to stay away. I post a lot of dog pictures. This is right outside of Las Vegas, believe it or not. We have more than deserts. We are also mountainous. And it's actually a really great place if you're a hiker. I love living here. Just real quick, if you don't know who I am and what I do, like I mentioned, I'm a broker, but I also write a column for Stocks and Commodities magazine. I contribute content to Mad Money on CNBC as well as Bloomberg Television. I do a segment called Options Insight about once a week, once every other week or so. And our clients do receive newsletters that we write in-house that include trading recommendations and ideas, commentary, that sort of thing. And one more quick note. If you're interested in learning more about trading commodity options as opposed to stock options, I cover that topic in extensive detail in really all of my books. A Trader's First book on commodities is ground level. It'll teach you how to calculate profit and loss on each of the commodities, that sort of thing. Probably the more complex is trading commodity options. And it talks a lot about selling options. It also talks about protecting yourself in case of some severe unexpected event. If you would have talked to me 5 years ago, I would have absolutely said, I believe naked option selling is the way to go. I've actually kind of changed my tune a little bit. I do think it's worth having some catastrophic insurance here and there. That doesn't mean you have to do credit spreads. It might just mean for every 2 or 3 options you sell, maybe you buy one cheap option just in case something weird happens. That way, hopefully you can ride out the volatility because as an option seller, the key to making money or surviving, I should say, is simply riding out the waves of volatility that come and go. Most of them are temporary. Some of them are only a day or two, but that 1 or 2 days can really wreak a lot of havoc on traders that are over leveraged, have too high of quantity, that sort of thing. So we'll talk about all those sorts of things, but want to make sure everyone understands that this is trading commodities and trading commodity options is risky. It's not suitable for everybody. It can be stressful at times. And the bottom line is this is a mental game, in my opinion. You can give 2 people the exact same trade and the exact same signals. One person might make money and one person might lose money. And the reason is the strategy or the approach wasn't bad. It was just the mental reaction to the good times and the bad times is different. And trust me, I've seen this over and over throughout my career. When I first started in this business, it was people received trading recommendations by fax. That's how old I am. And so I knew clients that subscribed to the same services and they received the same faxes. And sure enough, some people would make money, some people would lose money. And again, it's really the mental aspect of trading that makes the difference. So I'm going to be real quick on this first handful of slides, but I just want to make sure we're all on the same page. So most people, when they think of trading in general, they think of they think of stocks or ETFs or stock options because it's convenient. Their broker offers it and it's just easy. But convenience is rarely the right choice. Am I right or wrong? It's more convenient to go buy milk and bread at the convenience store because it's close and it's quick, but it's usually more expensive and you don't have a good selection, so on and so forth. So convenience is a negative, not a positive, usually. We've already talked about when you trade options on futures, you have around-the-clock market access. That's a really big deal. It may not matter 80% of the time or maybe even 95% of the time, but that once a year or once every other year that something weird happens overnight, if you have access to an account, it makes a really big difference. And I also think it works toward stabilizing your mental wherewithal. In commodity accounts, you have free leverage. You don't have to pay for leverage. You don't have to pay for the interest. A lot of stockbrokers will charge you interest if you're trading on leverage. You don't have to do that in commodities. Everybody gets leverage. And you can buy or sell in any order without any restrictions or rules. So whether you're trading futures or options, if you think that the instrument's going to go lower in price, you sell it. There's no uptick rules, no share restrictions, so on and so forth. One really big benefit of trading commodity options versus stock options is the low account minimums. Now, of course, this can work against you, so you have to be careful with that. But in the world of stocks, you generally need probably a $50,000 account or more likely a $100,000 account to sell options. In commodities, it depends on your broker, and we'll talk about that later. But you may be able to do it with an account of 10 to 20,000. Some brokers will even allow you to do it with less. We do in some circumstances. We'll talk about that. I'm not saying you should. I'm just saying you can. So make sure that you separate those two ideas. Alan already talked about the favorable tax treatment, so that's great. Commodities are also, they're exciting. That's probably why everybody tuned in this morning, is because it's interesting and it's exciting, and they've heard that anything is possible, and that's true. I once witnessed a trader take $10,000 to $500,000 in about 2 weeks. Sadly, he ended up losing it all because, first of all, when you make that kind of money off of 10,000, you probably traded rather aggressively, and he did. But that same aggressive level of trading, doesn't always work out in the long run. In fact, it never does. But that's just to give you an idea of just how much money can be made or lost in a very short period of time. And of course, that was an option buyer, not an option seller. So what we're talking about today would actually have been the opposite. So somebody that was aggressively selling options may have experienced massive losses during that time, whereas this option buyer was on the right side of the trade. So again, I'm going to be really, really quick because I assume all of you know this, but the idea of selling options on the surface, a lot of people get turned off because when you sell an option, you have limited profit potential and unlimited risk. That's the opposite of what human nature tells us we should strive for. But the reality is, when you sell an option, your odds of making money on that trade are automatically higher than they would be if you were a buyer in most circumstances. Options are eroding assets. Selling options provides ample room for error. You don't have to be right. You just have to not be really, really wrong. More options than not expire worthless. So in normal environments, buying options already puts you behind the curve. But of course, being on the right side of probability is not a guarantee by any means. We've all heard the horror stories that come with option selling, the account draining losses. There's a lot of bad press out there. And again, limited profit potential and unlimited risk is not necessarily appealing on the surface. So that turns people off. But with all of that said, I do believe that option selling should be a part of anybody's strategy, whether you're selling naked or preferably selling options to finance long options or some sort of premium collection strategy with hedges in place. I prefer having hedges just because I've seen some really crazy things over the years, and especially in today's environment, we have to keep in mind the markets have changed a lot in the last several years with algorithmic trading. Sometimes the computers pick a direction and they literally just drive prices to ridiculous, unsustainable levels. But that temporary spike can wipe out a lot of option sellers that aren't careful. So just be aware of the risks. I'm not trying to scare anybody. As I mentioned, I like the idea of option selling, and that's really, really rare to say as a broker. 99.9% of the commodity brokers out there are going to tell you do not sell options, most likely because honestly, it's a little more work for them. It's a little more stress for them. They have more risk on the table. I can tell you some horror stories. We had clients trading crude oil options exactly 1 year ago. There was an OPEC meeting. You may or may not have been aware of an OPEC meeting going into March of 2020. And it basically triggered a huge sell-off in crude oil. By the way, someone asked when crude oil reopens for the week. It opens on Sunday night at 5 p.m. Central. So at Sunday night on 5 p.m. Central, about a year ago, crude oil gapped lower about $13. So on Friday, it was trading in, I want to say, the mid to low 40s. And by Sunday night, we were printing 20s. So those kinds of things are rare. Again, I just want you to be aware of the types of things that can happen. We had traders that were short options worth $500-600 on Friday. They had plenty of margin. Everything was just fine. And by the Sunday night open, they had blown up their accounts. So be really careful with it. Just always respect the markets. Those things are rare. They don't happen often, but they can happen. You just always be woke. I don't know if that's the right word to use, but just know that markets can be really mean, and one bad day can wipe out a lot of work. So be careful and mindful of that. Never get too cocky. Let's just put it that way. By the way, when you're trading options and futures, particularly selling options is particularly naked, you do run the risk of losing more than you have in your account. In that situation I just told you about a few minutes ago, last year, we had quite a few traders that were not on margin call, that had plenty of margin on Friday night, but by Sunday night, they were in negative territory, some of them to the hundreds of thousands of dollars. As you may or may not realize how it works in the brokerage industry, but as a broker, if I have a client that loses more than he has on deposit, it's up to me to, first of all, make the exchange whole. So I have to pay out of my pocket to make the exchange whole. Then I go after the client for that money, and hopefully he can pay. If he cannot pay, which sometimes happens, there's obviously potential legal proceedings and those sorts of things. But if he cannot pay, ultimately I pay as the broker. And that's why a lot of brokers do not allow people to sell options, because they know if something weird happens and they have clients on the wrong side, it's possible that they have to basically finance their clients' trades, and that's no fun. Again, not trying to scare you, just trying to make sure you're aware of things that can occasionally happen. One thing that I hear quite often is traders looking at probability calculators. I know there's a lot of fancy option platforms out there that will tell you what the odds are of an option expiring worthless. Of course, we can also just use delta to do that. It's basically the same thing. But they rely on these numbers really heavily, and I think that's a mistake. Further, they pump things into their margin calculator or their option calculator, and that calculator will tell them what the market, if the market drops, let's say crude oil, if the market drops $3, what those options might be worth. But the problem with those is they're using today's volatility numbers. They don't know what the volatility is going to look like tomorrow. And markets aren't mathematical equations. They fluctuate based on human behavior and human emotions and reactions, and those can get really, really out of hand. Today's delta, today's volatility numbers, all that sort of thing will give us one number, one probability number, or one prediction of what an option might be worth. But tomorrow it might be a completely different story. Even though my calculator said this option would be worth X number of dollars if crude oil dropped $3, tomorrow if crude actually drops $3 or $3.50, that option might be priced much differently than what I expected. So just keep in mind, the world that we live in is messy. It's not an equation. Again, not trying to scare you, just want to make sure you aren't surprised. If you happen to be in the wrong place at the wrong time, you're mentally prepared for that. And ultimately, that is the difference between making and losing money. So when we sell options in our mind, we're kind of making a bet that the futures price is not going to exceed the price of the short option, correct? So if we sell a $50 put option in crude oil, we're saying we don't think crude oil is going to go below $50. However, when you're selling options, that's only one part of the equation. You have to understand that if you sell a $50 put and crude oil futures never drop below $50, you can still have a really big paper loss on that put. For example, you might sell it for 50 cents or $500, and let's say crude drops from $60 to $55, but it does it very quickly and people start to panic a little bit. Even though your option's still $5 out of the money, your 50-cent option might be worth $1.50, $2. So you could be taking a pretty big paper loss and that sort of thing. If you're going to sell options, you have to understand that's part of the game. Again, it doesn't happen all the time. Sometimes you sell options and it's stress-free and it seems like easy money, but that's not how it always works. Occasionally, you're going to have stress tests. So the takeaway from that slide is just understand you can have a really big paper loss on an option, even if the futures price never gets to your strike price. People that are looking to sell options on futures, for some reason, they have it in their mind that exercising is a bad thing. They're scared to be exercised. But to be honest, if you are exercised on your short option, it's a blessing. It rarely happens. The first way that your option can be exercised is if it expires in the money, the exchange automatically exercises it. Now, this is not as simple as you might think it is. Everybody wants to believe that the world is black and white. And if you have a 30-year bond option with a strike price of 155, let's say you're short a put and the market settles at 154 and 30 seconds, just under that, your strike price, just in the money. As an option seller, you want to know the exchange is going to exercise that automatically, and you can go on with your business and proceed accordingly. It's not really quite that easy. 99 times out of 100, that's how it's going to work. If the exchange sees that your option expires a tick in the money or 2 ticks in the money, it will automatically exercise it. But as an option seller, you don't have the rights. The buyer has the rights. Believe it or not, the buyer has a handful of hours after expiration to contact the exchange and say, I do not want that option to be exercised. I want to abandon it. And that just happened to us 2 weeks ago on a trade. A client had a vertical spread, and they were both in the money. The short option was in the money by a couple ticks at expiration. He assumed that the trade was over, everything was unwound. But surprisingly, over the weekend, we received a notification that the buyer had abandoned that option. It was not exercised, and he was now holding a futures position going into Sunday night. So my advice is, don't hold the expiration. Always get out. Even if let's say your option looks like it's going to expire worthless and it's only worth a few pennies, just buy it back. I mean, you're literally, when your option's worth a small amount of money, let's say crude oil option worth $10 or $20, you're accepting unlimited risk to squeeze out that extra $10. Trust me, I know it's going to work out most of the time, but it only takes one time to really ruin your account. I've seen it over and over. I've seen people not buy back wheat options that were worth a half a penny, which is 25 bucks one day, and then the next day they're worth 2,000 or 3,000. It can happen, and you don't want that to happen to you. That $10 you pay to get out of the nearly worthless option is not going to change your results. Do it and don't even think about it. Now that we got that out of the way, the other way for an exercise to occur is if the buyer chooses to exercise that contract. So if you sell a crude oil input, if you sell a crude put, and at some point before expiration, the buyer decides he wants to exercise that into a futures, he can, but he's not going to. And the reason being, he can simply, if he's long that put, or she, they can simply sell that put and they get the extrinsic value and the intrinsic value, and they walk away and it's clean and easy. Exercising it, number one, is a pain in the butt. Number two, they are giving up the extrinsic value. So it's never going to happen. So don't let that keep you away. There's so many things that can keep you away from trading options on futures. Don't let the thought of being exercised do it, because it's literally no big deal. It rarely happens. And if it does happen, it's usually not the end of the world. But again, I do recommend that you always buy back any short option that has made most of its money. But as a broker, I can tell you, people get in trouble all the time doing that sort of thing. To make an extra $10, they lose a lot more. It's not worth it. Okay, so as an option seller, you're going to have to make a decision. Do you want to sell a high quantity of options deep out of the money, or do you want to sell fewer options closer to the money? The options that are closer to the money are going to bring in more premium, but of course they have a higher probability of dipping in the money. I don't know exactly what Alan's strategy is, and I'm not saying, one thing I want to say up front, I'm not trying to say any strategy is better than the other or vice versa. Trading is really not a black and white game. You have to find what works for you, your personality, your mental makeup. The secret is to find something that you can do that you trust, that you're not going to panic as you're employing the strategy. That's really what it's all about. So don't think that I'm trying to say one way is better than the other. I'm not. You have to feel that out. Everybody's on their own journey. With that said, I want to point out this point that some people have it in their mind that if they're selling options, they should sell really deep out of the money options. Even though those options bring in a small amount of premium, the strategy is to sell several of them to collect the premium that they want to collect. And the thought is those options are probably never going to be in the money. And so it's just easy money, right? You're just printing money, but it's not quite that easy because it's those deep out of the money options that explode in value and become a real problem. Traders, even though they're right, let's say that they sell a $40 crude oil put and they bring in, I don't know, $100 each, $50 each, something like that, but they sell a bunch of them. The odds of crude getting to 40 in their time frame are probably pretty low, but that really doesn't matter because if they sell a cheap option worth 50 to 100 bucks and that option becomes 10 times or 20 times its value just temporarily on a volatility spike, there's a good chance they get knocked out of the trade because of margin, they get scared, they panic and get out, or they simply just run out of money and blow up their account. And that can happen whether crude ever gets to 40 or not. I see it happen all the time. Quantity kills. You want to find a happy medium between selling close enough to the money that you can get enough premium to do it without selling high quantities. I've seen people survive market crashes selling a one lot, and then people that are selling 10 lots of deep out of the money just completely blow up their account in a matter of hours. So it does matter. I'm going to show you an example here. What I'm talking about is the deltas of 2 or 3 where traders feel like they have to sell a whole bunch of them to make it worth their while. That's where people get into a lot of trouble. Also keep in mind quantity risk, because your risk is not in crude oil dropping sharply. It is, but your real risk is having too many of them on and not being able to ride out the volatility spike. I know this is kind of hard to grasp in a couple slides, but selling closer to the money options with higher deltas, but in lower quantities, is actually in many cases less risky than selling the deep out of the money options. And the reason being, when the market really starts to move, speculators jump on the cheap options. So on a percentage basis, those cheap options absolutely explode. For example, an option worth 100 bucks might soon be worth $2,000-$3,000. It happens. I know it sounds crazy, but it happens all the time. If you originally sold an option for 500 or 600, that option might also, obviously it's also going to take some heat, but on a percentage basis, it's not going to be quite as dramatic. And you're probably trading fewer quantity if you're selling close to the money. So from my experience, what I've seen, those types of traders, lower quantity but higher quality options, tend to fare better when things get wild. I'm just going to skip on over. I'm going to compare this strategy. I'm just going to kind of give you a visual of exactly what I'm talking about. And again, I'm not trying to coach your strategy. I just want you to understand how the market works, because the first time you experience a really wild market, you need to understand how the mechanics and how things tend to behave relative to options with various strike prices, so on and so forth. It'll really help you out. Trust me, and also hopefully it will help you to not panic because you kind of understand how it works and what's going on. This is an older example. I really wanted to refresh this. I just didn't have time. But in 2016, days before the presidential election, a premium seller that wanted to collect $1,000 in gold could have done it 3 ways. Okay. By the way, as this slide was being written, gold was trading at about $1,280, or we'll call it $1,300, just to give you some context. So this trader believes that gold's probably not going to go down. Hopefully it goes up, but if it does go down, it doesn't go down more than a couple $100. So there's 3 ways this trader could have done it. He could have sold 2 1150 puts for 500 each. That brings in 1,000. That trade has a delta of about 8, or let's say 10. That's a 10 delta. We'll just round it. And a roughly 90 to 92 chance of expiring worthless if held to expiration. I also should mention, when we talk about chances of expiring worthless, I already mentioned that those chances can change dramatically from day to day. So don't rely on that number and refuse to get out of a trade because that was your original number. Most traders don't hold to expiration, so does it really matter what the odds are of it expiring worthless? So just keep that in mind. In this situation, this trader sells 2 puts. He collects 500 each. That's $1,000. They're a delta of 10. Pretty good odds of success. I think we can all agree. Not guaranteed, but good odds of success. The position delta is 16. This is one thing I want to point out also. If you're selling multiple quantities, you have to multiply your delta by the number of contracts you're trading. Otherwise, you're really living in la la land. So if you're trading an option with a 10 delta, but you sell 10 of them, your delta is actually 1, meaning It's kind of almost like being long or short a futures contract. So just again, not scaring anyone, just want to make sure everyone understands exactly what their risks are. So the other way the trader could have done it is he could have sold 5 April 1100 puts. The delta on that is only 3, making his position delta 15. Or he could have sold 10 of the 1050 puts. Now the odds of gold dropping from 1280 to 1050 in that time frame, I think at this time, I think this was maybe a 60-day, I should have put that, but I think it was about a 60-day expiration. There's a 99% chance of those expiring worthless. The position delta is only 10, so on paper, it looks like it's a better deal to sell 10 of the 1050s, because what are the odds of the 1050s ever getting in the money? Very slim. And you're collecting the same amount of money, so on and so forth. On paper, that makes sense. But in reality, it's actually less risky to sell the two 1150s, even though your strike price is much higher. So this is what happened afterwards. Gold dropped from roughly 1280 all the way down to 1125, which means those 1150 puts that the trader could have sold 2 of actually became in the money. They were $20 in the money at one point. The 1100s and the 1050s never became in the money. Let's see what the drawdowns were on those positions. So the 1150s we sold 2 of would have had a $9,000 drawdown. Ouch. But if we look at the selling the 10 options of the 1050s, the drawdown would have been 12,500. So depending on account size, that may or may not be a huge deal to you. Maybe the $3,500 difference isn't a huge deal, and you still feel like selling 10 of the deeper out of the monies is a better way to go. But you also have to consider margin requirements. On the first example, where you're selling 2, your drawdown's 9,000, which is a lot easier to handle than 12,500. You're only margined on 2 contracts. When the market drops that sharply and things start to get in the money or near the money, as these options did, if you have 2 margins exploding on you, you're far more likely to be able to ride it out as opposed to 10 margins exploding against you. The margin on the short 1050s will undoubtedly still be lower than the margin on the 1150s, but not enough for the quantity difference. So the odds of you being forced out due to a margin call are going to be much, much higher if you're selling 10 of the deep out of the money options than you would selling 2 of the closer to the money. So again, not trying to coach you on strategy, just trying to let you know this is how the markets work. So it's deceiving to think that selling deep out of the money is the less risky way to go, because that necessarily isn't true. You might say, why don't you just sell 2 of the 1050s? Well, you could do that, but you're only collecting $200 versus $1,000, and $200 might not be worth the risk and the time. And so if you're selling deep out of the money, you're basically encouraging yourself to sell a higher quantity, which is where people get into trouble. So trading is basically an emotional game. It really is. It's like sports or anything else. How you manage your emotions is what's going to determine whether you make or lose money. It's that simple. This is a quote I try to keep in my head all the time. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. I find that to be very, very, very true. People that are highly educated and very mathematical and scientific in the way that they think sometimes have a hard time with the markets because honestly, they're too smart. They want things to make sense and things don't always make sense. Alan mentioned Tesla having a market cap bigger than all other car makers. That doesn't really make sense. So somebody that thinks in the manner that they're seeking answers might really have a hard time with the markets. And that's understandable. Another thing I like to keep in mind is Paul Tudor Jones once said, every day I assume every position I have is wrong. And I think that's a good way to approach things. That way you stay on your toes and you don't get complacent. Complacency really, really kills. I mentioned that this is a mental game. I should also mention markets are mean. Markets tend to find a way to cause the most amount of pain to the highest number of people. That's literally what happens over and over and over. It's a cycle. It's just how it works. As market participants, the goal should be to avoid being in the wrong place at the wrong time and being in a situation where we allow the market to be mean to us. If you trade long enough, the market's probably going to make you cry. I've talked to and heard several grown men cry. It's not fun. Sometimes it's not even financial losses. Sometimes it's just frustration over being wrong or just not finding the edge, or, sometimes drawdowns can really, really wreak havoc on somebody's confidence. So when you're putting your positions on, I encourage people to expect the worst and hope for the best. again. That's how you try to stay on your toes. You always want to be aware that things can go wrong. There's no easy money in the markets. There's no free lunches. You should also, before you put on your trade, think of what you think might be the worst case scenario. Ultimately, we never know what the worst case scenario is. For example, before March 2020, I don't think any of us could have fathomed what worst case actually was. Nobody could have imagined that until after it started unfolding. That said, we can kind of guess at what we think might be the worst case scenario. And if that causes, just thinking about it causes you too much stress, then that trade's probably not for you. If you're stressing yourself out with your trading, if you're not sleeping at night, you're going to make bad decisions. That bad decision is going to probably lead to revenge trading, and that's a very destructive behavior, and it never ends well, unfortunately. So one more quote. Thomas Jefferson once said, "Nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances." I find this to be true. But the reality is, keeping a clear mind is something that some people are fortunately born with it. Some people just don't get stressed out, and they're lucky. Most people, that's not the case. Most people actually have to work at it. It takes practice, but more importantly, it's part of putting an environment together that works for you. Everybody has a different risk tolerance and a different stress point, but what you need to do as a market participant is to simply put yourself in a situation where you're not going to be forced into panicking. These are just rules of thumb. Everybody has different ideas, but this is my thought. When it comes to selling options on futures, in order to survive and stay sane, you should probably take these steps. Your margin to equity ratio is important. Now, this gets complicated because not all brokers charge exchange minimum margins. We do. So if you're at a brokerage that upcharges margin, they're charging you more than what the exchange requires, then you may want to adjust these percentages accordingly. But at our brokerage, we charge the exchange minimum. I recommend that if you're selling naked options, you probably want to keep your margin 25 to 35% of usage, meaning you're leaving 75 to 60% of your account open in unused margin. Some people look at that as you're wasting money, you're not using that capital. But in my opinion, that's your piggy bank, your safety, your cushion, so that you don't get forced out of trades prematurely, and that's the worst thing that can happen as an option seller. Also, refrain from selling cheap options in low volatility. You want to try to sell call options on rallies and put options on dips. That's exactly opposite of what human nature wants us to do. Let's say, for example, you're selling a crude oil call option that you're selling it for 50 cents today, but 3 days ago it was worth $2,000. You're essentially selling it on the discount rack, right? It might work out, it might not. But if you're constantly selling options that are cheaply priced in the market, you're putting yourself in a situation where you're more likely to be in the wrong place at the wrong time. So try to sell options that are expensive, not cheap. Keep your quantity small relative to your account size. I always recommend buying back options once most of the premium's been gained. I explained that earlier. I've seen really horrible things happen to people that were trying to make an extra $20 on their short option. Look, $20 is nothing, right? It's not going to change anything. If you pick up that extra $20, great, and it's going to have more often than not, it's going to work out, but it's just not worth the risk. In other words, you should look at it, even though you already have the position on, you should also ask yourself, if I didn't have this position on, would I sell this option for $20 to have limited profit potential and unlimited risk for $20? The answer is probably not, right? Okay, so buy those back. And there's nothing wrong with being on the sidelines. Sometimes there's no market volatility. Now, in 2020, 2021 so far, we've seen tons of volatility. So as an option seller, there's probably all kinds of things that you want to, that you're looking at and you want to participate in. But in 2019, volatility was slim, and it was really hard to find places to sell options that made sense. Because if you sell an option when volatility is really, really low, and we switch from a low volatility to a high volatility environment, you're toast. It's really hard to keep up with that. So really try to avoid markets that have low volatility. Right now, volatility is extremely high in markets like copper, gold. So you can sell really wide strangles, or if you wanted to go directional, you can sell one side or the other for a lot of money and still be quite a ways away from the market. A few years ago, that wasn't possible. You would have had to sell options right on top of the market, and eventually that would have caught up to you. So being on the sidelines is perfectly fine. It lowers the risk of being in the wrong place at the wrong time. And as an option seller, that's what will eventually hurt you, just being in the wrong place at the wrong time. Sometimes it's bad luck, sometimes it's being greedy, sometimes it's a little bit of both. And proactively hedge. Don't stick your head in the sand and just always assume everything's going to work out. Most of the time it does, but it doesn't always. Don't be afraid to hedge. That might mean buying a micro contract against your short option. It might mean buying a cheap option just to act as catastrophic insurance. But trust me, you'll be happy you did if things get really wild. So there's no such thing as easy money. I know sometimes selling options seems like easy money, but that it's not. And eventually it'll catch up to you if you're taking on too much risk. So don't sell massive quantities of low price, deep out of the money options, even though the margin calculator tells you that there's not a lot of risk in that. Trust me, there's a lot of risk in that. That's not the way to do it. Don't blindly sell options without considering fundamental analysis, technical analysis, seasonal analysis. Be aware of everything else. Don't collect premium just to collect premium. And a lot of people like to sell the weekly options, for example, options that expire in a couple of days, and they sell them in high quantities. Again, this is a strategy that can work for a very long time, but when it doesn't work, it's going to really wipe everything out that you just worked so hard to get. So be really careful with that sort of stuff. If you're going to do it, make sure you hedge. Just want to mention, keep in mind, I'm a futures and options broker, and I would love for everybody to do business with us, so I'm biased. So keep that in mind as we go through the next few slides. But even with that said, even if I wasn't in this business, I would still probably give you mostly the same advice. And the reason being, if you want to sell options, don't just open with any random brokerage. Open with one that will give you the freedom you need to do what you need to do. Most commodity brokers restrict option selling. They either forbid it outright. In fact, a lot of them forbid it, or they'll forbid it in most markets or expiration months. So they'll only allow you to trade 4 or 5 markets and only the first couple of months. Others, they allow option selling, but they pad the margin requirements. So for example, if you're selling a strangle, a lot of them will charge you margin on the short call and the short put, which is ridiculous because you can only lose on one side. But they do that because they're trying to deter clients from taking on risk. And like I mentioned before, it's more work for them. Also, some brokerages will allow you to sell options, but as soon as things get hairy, they liquidate the account without letting you know. They literally just go in and blow out positions. And as an option seller, that is a complete nightmare. I've heard horror stories of losses of tens of thousands of dollars being locked in, and then literally the next day, everything would have been just fine. But to that person that was liquidated, they took the big loss, and now they're sitting on the sidelines watching everything normalize. That's really frustrating. So make sure your broker allows short option selling, charges the exchange minimum, and does not restrict you, and is not going to force liquidate you unless it's the last option. Our brokerage will force liquidate clients if they're in danger of losing more than they have on deposit, and even then we still can't catch everything. I just told you the horror story from a year ago. But we'll do our best to do that. But other than that, we're going to let it's your account, your money. We're going to let you do what you need to do as long as it's reasonable. We're not going to step in. That said, not all brokerages will do that. Another mistake people tend to make is they choose a really fancy trading platform and they go with that, and they just happen to open a futures account with whichever brokerage has that trading platform. And I understand that. It's nice to have a nice platform and all those tools and all those fancy calculators, but the best platform in the world is a piece of junk if the brokerage backing it doesn't know what they're doing. I can tell you that 100%. If you can't call up your broker and ask questions and they can't answer them easily and efficiently, or if they can't answer an email, or if they're charging you too much margin, or if they can't even tell you when the market's open, it's not worth it. You need to be with a specialized broker that can help you and answer your questions and facilitate your trading. Again, some people think that it doesn't matter which broker you choose and they're looking for the cheapest commission. But I'll tell you this, you really always get what you pay for. And it may not matter 99% of the time. It may not matter because nothing arises, no issues arise. But eventually, one day, maybe it's this year, maybe it's next year, some sort of issue will arise. Maybe it's a platform outage. Maybe it's extreme volatility in the markets. Who knows? Something will happen where you need your broker to step up to the plate, and they won't because you chose a broker based on either commission or trading platform. And there's a lot more money to be lost in the markets that you'll ever pay in commission. For example, if you're worried about an extra dollar or two, trust me, that's not going to determine whether you make or lose money. But if you have an issue with your account and you're put on hold for an hour while the market's moving against you, that's going to make a difference. Option sellers in particular. Now, if you're trading futures outright and day trading futures, honestly, the brokerage may not have a huge impact on what you're doing. As an option seller, it's going to have a massive impact on you eventually at some point. If you're trading with a discount broker, what that means is they have really tight profit margins. And so they cut corners, because if they didn't, they would have no way to make money. So what they do is, again, they restrict trading, they interfere with your trading, they blow positions out. Because remember, I told you, as the broker, I'm responsible for any account that goes negative until the client pays. Well, just imagine if you're a discount broker and you're only making 2 or 3 cents a trade, you're not making enough to call anybody or email anybody or to even accept any risk whatsoever. So what do? You just blindly liquidate everybody if you think there's any kind of issue. So you get what you pay for as an option seller. It can make a really big difference. We kind of already talked about this, so I'll kind of skip it, but make sure your broker offers span minimum margin. That span minimum is portfolio margining. And what that is basically they take your entire account into consideration, all your positions, and net the risk, as opposed to charging you outright positions on each trade. Like I mentioned before, if you're selling a strangle, you shouldn't be charged margin on the short call and the short put, because you can only lose on one side. Span portfolio margining nets the margin. It'll basically only charge you margin on the riskier side, and the other side goes uncharged. That can be a huge difference, because even if you have a big account and it's not changing the trades that you put on, it can change one thing: margin call triggering. If your brokerage is charging you too much margin, you're more likely to get a margin call. And in that situation, you may or may not be able to immediately wire funds to cover that call, or maybe your broker doesn't even ask you if you can wire funds. Maybe they just go in and liquidate it. Again, we wouldn't do that, but some brokerages do. So you always want to be aware of who you're trading with and what their policies are. So again, if you're interested in learning more about commodity options, my book, Trading Commodity Options, you can find the website here, tradingcommodityoptions.com. It goes over literally anything you could possibly think about option trading, including option selling. There's quite a bit of information on option selling and how to hedge if things go wrong, how to adjust if things go wrong, all those sorts of things. And just as an FYI, if you go to Amazon and search my name, you're going to find a lot of books that I didn't mention today. Don't worry about those. Those are from previous publishers. They're out of print, and they're only available like on the second market. So the prices are just silly. Don't pay those silly prices. All you need are the 3 newest books. They're the best looking books. They're the most creative covers, just like this one. Okay, I'm really short on time. I apologize. If you have any questions, comments, concerns, you can reach me here. This is my email address. I try to answer emails pretty timely. You can also give me a call, or for sure follow us on social media. We try to post, in addition to dog pictures, we try to post charts and commentary, links to webinars, events, things like that.